Hey everyone, Tom Gentile, and before I take off for the weekend, I got everything ready to go, but you know what? I got my laptop over here, and I got my television on, and I want to talk about gold before I take off from where I am now, heading up into the Catskills. Let me shut off the engines, get over here in the other chair, and we'll talk about it. All right, once again, welcome to Tom's Trading Room, or Tom's Mobile Trading Room. We're going to talk about gold today. It has a lot to do with this major market melt-up video that I did earlier in the week. And I want to mention right now, guys, if you like this video, if you find it interesting and educational, give me a thumbs up below. That helps our YouTube algorithm and puts this video out to as many people as possible. Also, if you subscribe to the video or you subscribe to our YouTube channel, then you'll get these videos as soon as they're uploaded. So what's going on with gold? Well, you go out there and you look amongst the major publications. They're showing things like gold is going higher despite recent surge, says investor who's managed precious metals fund for a quarter century. Another one, stock market bulls should consider owning gold as an insurance policy. And gold 2000, precious metal surges to record high as the dollar falls. And it's not just major media that's talking about it. You know, you go on social media and you'll see social media reviews such as Gold ETF Frenzy drives gold to all-time highs. Alan Cohen says, first time in my 40-year plus mutual career that I'm bullish on gold, mutual funds, and gold ETFs. And, you know, others talking about GLD conversations, just the tip of the iceberg. Richard says spot gold rises above 2,000 for the first time on stimulus hope. You know, I want to talk about really three things, and I have them in threes, so I'm calling them 333. Three interesting charts of gold, three runaway gold stocks that are on my watch list, and the three best gold option plays for playing this as what I call the long game. Here's the first chart I want to show you. Okay, so this is a chart of gold, a candlestick chart of gold, and let me just show you what we're talking about here. Candlestick chart of gold, and this is going back to the end of April. The breakout really occurred near the end of June, but it started to really gather steam in mid-July as we went above 170. We went above 170, and toward the end of this week, we were hitting 195 on GLD. Now, the other lines I want to show you, the 10 and the 30 period moving average, these are trendy lines, and I use them a lot in trending situations. They flagged a potential move up in gold, in GLD, below 165, so that indicator's proved very useful. Finally, the blue line that you see on the screen, this is options implied volatility. All right, because I'm an options trader, I want to show this to you all as well. And what it showed was back in April and in May, volatility in gold was quite high. Volatility in everything was quite high at that time. But as you noticed, this volatility dropped. We hit a low point around mid-July, right before we busted above and started climbing out of the 170 mark. Once we started doing that, we saw implied volatility rushing in as option buyers were going crazy to get some of this options on yellow metal, like this ETF GLD. Take a look at the volume in gold. All right, this is the last 90 days as well. So you go back to the end of April, and you see the volume in gold was averaging around, and this is GLD, around 10 million shares a day. Mid-July, we started picking up steam, and we just recently hit 26 million shares in one day on GLD, on the actual stock itself. But Tom, what about the options? Let me show you the third chart. This is the put and call volume on GLD. So as you can see here, we're looking at four different graphs here. I've got a black line, which is total volume of calls and puts combined. I have the red line, which is the call volume. I have the blue line, which is the put volume, and the green line is the 30-day average. Now, I want you to focus on the red line versus the blue, because red and blue, we're looking at, again, put to call volume on gold. And this is not the ratio, but the actual volume. So put to call volume on gold has been about 2 to 1 on average. 2 times as many calls purchased as there has been puts. Now, there are times when it came down very close to 1 to 1. Right, back in mid-April, again in near the end of May, again around mid-June and end of June. But look what's happened since the middle of July. The number of calls has been racing up to the number of puts. Right now, I want to show you 3 more charts. These 3 charts are what I like to call Tom's movers. Now, I took a piece of Tom's movers out of tomsoptiontools.com. That's our proprietary option software, but we do have a lot of stock analysis in here as well. What I'm looking at is I ran a list, and I'm showing you the top 3 stocks where in the last 7 days, the minimum stock price had to be $10. The minimum high to low percent move. And what this is that the highs to lows in a single day, going back on average of 7 days, had to be above 2%. It means that the stock in question had to be moving much greater than averages, like the S&P 500. As you can see here, Kirkland Lake Gold was on the top with 7-day stock moves. We're talking about 7.17%. Okay? Now, the median is what we look at, which is that 7-day move. Not the percent change, but the move between highs and lows. 5.3% on Kirkland. Cisco Gold, 4.5%. Newmont Mining, which a lot of you know that name, 3.47%. Let's look at each chart individually real quick. Here is Kirkland Gold, and what you can see here is this is not Bollinger Bands for some of you that are thinking it is. This is an area where each day the price of this stock exceeded the 2% range between high to low. As you can see with Kirkland, every day going back to February. Same thing with Cisco Gold. Every day going back to February, this stock has exceeded that 2% trading range from high to low. Newmont Mining, well, it did it too every day except the stretch down here around mid-July where it got really quiet as it was coming up to earnings, and now it's back at it again. So these 3 stocks have been moving significantly and have had some significant gains since earlier this year. Now, it leads me to believe that one of 2 things could be happening. A, everybody's right on gold, or B, we've got a FOMO situation going on here, a fear of missing out. All right, so I don't want to rush in and buy gold immediately like it seems everyone else is doing this week. What I want to do is I want to take a calculated longer-term approach. And so I want to show you 3 longer-term approaches as we talk about the highlights of gold. Gold right now is reaching all-time highs. Gold and gold stocks may be in FOMO moves, suggesting pullbacks. So how do you invest in gold with a long-term luster effect that's happening with this asset? Well, let's talk about 3 different ways. Number 1, we can invest in the ETF itself, GLD. And if I were investing in GLD, I would be looking at something called dollar cost averaging. Dollar cost averaging means periodically buying equal dollar amounts to average in on its rise or fall. So you're buying as it goes up, you're buying as it goes down. As it goes down, you would be buying more because you'd take the same dollar weight and put it into the shares. As it goes up, you'd be buying less in shares. So for instance, if you put $500 a month to this strategy, you would put $500 into GLD regardless of its price. You get more shares as it goes lower, you get less shares as it goes higher. That's called dollar cost averaging. Again, how much depends on you. Check with your broker investment advisor and act accordingly due to your own risk. Now, the exit strategy would be based on where you see GLD going. I've got 2 targets myself. 200 as a shorter term target and 250 as a longer term target heading into the November elections. Next, another area, now I'm going to go into options. This is something that I do. I sell put options on this asset. Now, I'm not a big fan of selling naked puts. Selling naked puts means that if I sell the put options, I'm going to get paid a premium, but I'm obligating myself to purchase this asset at the strike price in which I sold the options for. So, for instance, I like selling out of the money puts on gold. In this case, I'm showing you over here the October 16th 175 puts. Yeah, by the way, more than 20 points below where the price of GLD is right now. They're trading around $2. So if I went out and created this trade, sell to open, the October 16th 175 puts, I'm going to bring in $2 if I'm filled. That means I'm going to bring in $200 per contract, right? But I'm also obligating myself to purchase GLD at 175. I would love to purchase GLD at 175 because it's 20 points below the market price right now. Now, if gold remains above this strike price by expiration, the option's going to expire. I'm not going to get my GLD, but I'm going to get to keep the premium I received to open this position. But if GLD goes below the 175 strike price, then I am obligated to buy that 100 shares of gold at the strike price if it's below it at expiration day and I'm still holding the short. If you don't want to put that kind of risk out there, then, now I'll tell you this, I don't like the call options right now. I would not buy calls, longer dated calls on GLD. They're just too expensive. But what I would do is consider a call spread. A call spread is buying a lower strike call and selling a higher strike call. This is a bull call spread. All right, I'm bullish on the trade, but what I want to do is I want to spread off my cost and my risk. You could do it this way: buying the lower strike, selling the higher strike, and you do that for a combined cost. Now let me show you what I'm talking about. The GLD October 16th 200 calls, well, they're trading for about $7 to $8 right now. Okay? But the 210s are trading for around $5 to $6. So if I were to buy to open the October 16th 200 calls and simultaneously sell to open the October 16th 210 calls, I am doing this for a price of $2. Remember, I'm going to pay the higher premium for the 200s, but I'm also going to receive premium for the 210s. This is a call spread. Now, this is only going to cost me $200 per contract spread, plus maybe a little commission. But it lowers the cost and risk versus an outright call purchase. Now, the reward's capped, but the reward to risk ratio can be high. Get an idea, let me show you what I'm talking about. This trade here, if it cost me $2, the most I can make is $10 minus the $2 I paid. So I could take in $8 on this $2 of risk. That is a 4-to-1 reward to risk ratio. So in summary, there's many different ways that you could purchase GLD, your favorite gold stock, or even options on GLD. I just showed you just a few ways to do this. Let me hear your comments below. Have a great day. I'm getting out of here.